those standards. IFRS is now used by companies in more than 100 countries. Most G20 members now require the use of IFRS, and the remaining major economies have established plans to migrate towards the use of IFRS. India is also converging to IFRS in the coming years. Australia has already adopted Australian equivalent of IFRS since 2005 and is one of the few countries which is well advanced in its adoption of IFRS. With this, I bring you our next speaker, Margot Lebas, who is an acclaimed subject matter expert in this area and is widely acclaimed in the industry and among peers for her expertise. Just a brief profile of Margot. She's a partner in PwC's Specialist Accounting Advisory and Capital Markets Group, and she has more than 18 years of experience in assurance, financial reporting, regulation, and compliance, both within Australia and abroad. I just asked Margot before she came in about her connection with India. She does like Indian food, butter chicken, no prizes for guessing that right. And she's celebrating her mom's 60th birthday with a Bollywood party. I was just concerned that, you know, this should not become an invite like the ones we get on Facebook, but hopefully it'll be, you know, a private party. Anyway, Margot has worked extensively with the investor community and the media to understand the information needs of users of financial reports and to help these key stakeholders understand emerging accounting issues. She regularly contributes to debate on accounting standard setting and emerging issues through numerous global PwC committees. Please put your hands together to welcome Margot Lebas. Let's just check if this is working. Yep, it does.
Great.
Yep, just press a bit hard.
Okay, thank you. Okay, well, good afternoon, everybody. Thank you very much for that kind introduction. I'm very pleased to be here today, and it was lovely to meet so many of you over lunch, so thank you for making me feel so very welcome. In the time we've got this afternoon, I'd like to spend a bit of time reflecting on a number of the financial reporting issues that we've seen in the last financial reporting season, so that might help you think about the issues that you might need to consider in this upcoming reporting period, whether that be for December or for next June, but also talk about what we've got coming up in the pipeline and the issues that you might need to start thinking about and preparing for the next sort of 12 to 18 months. So with that in mind, I might sort of set the scene, and I think a bit of that has already been done in the introduction, but in the last sort of 12 to 18 months, maybe even 2 years, we really haven't had a lot of new standards to actually deal with, no new brand new standards. Now that's not to say that the International Accounting Standards Board hasn't been busy. They've been very busy on a lot of project work, but we haven't actually had any new standards to apply. We've had a few improvements and a few things around the edges. But what we do have is a range of new standards that are going to be applicable for the first time from the 1st of January. And we'll cover a number of those today. So IFRS 10, 11 and 12, which deal with issues around consolidation, joint arrangements and disclosures in financial reports. We've also got some new hedging rules that might imminently be approved. We were hoping that might happen by December, but it's looking like it'll be in the new year. And as I said, the ISB has continued to busy themselves with a range of projects that are both in response to the GFC and also part of the convergence project with the US. So the three big main ones there are around revenue recognition, financial instruments and leasing. And if you've been to sort of technical update sessions, you'll remember that we've been talking about these three projects for probably the last 5-6 years, perhaps even more. So we are hoping to see some progress in at least one or two of them within the next 12 months. And then finally, I guess the last thing to touch on in any sort of set the scene is where is the SEC in this? So we have all been waiting for some time for the SEC to make an announcement as to whether they would intend to adopt IFRS, and we're still waiting. So the SEC staff did issue a report in the last sort of couple of months, and look, they highlighted a number of the issues with adopting IFRS, but you know, they're all the issues that we've already dealt with here in Australia. So I think it's still going to take quite some time before the SEC gets themselves on board. So if we perhaps kick off the session by what I'd say starting local, so having a think about some of the issues that we've seen in the last reporting season. And here I'd like to focus on, in particular, or through the lens of what are the issues that the regulator has been looking at. So what are the issues that that ASIC has been focusing on? So the first issue I'd like to talk about is ASIC's guidance around disclosing non-IFRS financial information. So ASIC released last year, it's probably almost 12 months ago now, a regulatory guide on disclosing non-IFRS financial information. And when I say non-IFRS financial information, I mean when a company reports an underlying profit number, they report a management adjusted EBITDA number, they report some sort of consistent earnings number. And I think ASIC recognises that this sort of information is useful to investors if it's done in the right way. And so what ASIC has done is they issued a regulatory guide to help companies ensure that they're not misleading investors when they are providing this sort of information. And this guide covers not only financial reports, but also covers anything attached to the financial report, and it also includes things like press releases and investor presentations. So it really is quite far-reaching. And what the guide sort of focuses on is, and I'd say there's three key aspects to it, is the key principles when someone's going to disclose some non-IFRS financial information. The first is an issue around prominence, the second is around consistency, and the third is around reconciliation. So when I talk about prominence, the issue that ASIC is talking about there is if someone's releasing financial information or a press release and the only information they talk about that is a management adjusted number, then they would say that's been given undue prominence compared to the statutory financial information. And so we've actually seen examples of ASIC sending letters to companies to say that they think a company's got a disproportionate number of references to a management adjusted item in their press releases. So that's just, I guess, the piece to focus on there is to make sure that due regard has been given to both numbers. There's also a piece around consistency, and here we're talking about presenting this information in a consistent way year on year. So not just, I guess, taking out the bad news and making sure that each year you're not taking out and putting back in different things so that you've got some consistency. And finally, ASIC has said to everyone, you need to put in some reconciliations. If you're going to disclose this information, you need to have some reconciliations between the non-IFRS number and the IFRS number so that investors can understand how to reconcile the two. And I think as a consequence of this, one thing we have seen quite a lot of is companies are predominantly putting this non-IFRS financial information in their segment notes in the financial statements. And that really is the proper place for it to be, because if we think about segment reporting and the types of disclosures required there, it's all around how does management manage the business, what's the information they use to enable them to make decisions. So this one, I think we'll continue to see ASIC focus on it. It was applicable, or it's been in existence for sort of 12 months now. We've seen a number of letters coming from ASIC to companies asking them questions about their press releases and their financial statements, and I think that that will continue over this next reporting period. So I think one of the consistent themes with the issues that ASIC are interested in is disclosure. And so this has been a focus area, and in particular this issue of impairment disclosures has been an issue on ASIC's radar for quite some time. I sort of feel like the last couple of years ASIC's list of focus areas probably hasn't changed all that much. And in this respect, the issue around impairment disclosures is ensuring that enough disclosure is being given around the key assumptions that are used in any impairment analysis, and in particular the sensitivity of those assumptions, so that an investor can understand if particular assumptions move, what would the impact be. And ASIC's been getting pretty savvy about the way that they approach financial statement reviews and impairment disclosures. So they've got some very good people there now looking at impairment models. So if your organisation gets asked for information about impairment models, they will expect all the detailed workbooks and calculations. So my advice is to make sure that all your models are well documented and that you can produce that information if ASIC requests it. Now, probably in line with impairment. Another issue that ASIC's focused on is the recoverability of deferred tax assets. So here I'm talking about predominantly the circumstance where a company has had a history of losses and has recognised a deferred tax asset for those losses that they think they'll be able to, or it's probable they'll get the benefit from it in future periods. And the issue that's been focused on here is around the disclosure about the evidence that a company has, or the assumptions that they've made in respect of forming that view that asset is recoverable. I think the other thing probably to note here for those of you who are practising here in Australia is that there is no rule of thumb under IFRS for how many years out you can look for determining what your taxable profits will be. And so in Australia here, historically or before IFRS, we did have some guidance about how many years to look out, and people were generally looking somewhere between 3 and 5. Now under IFRS there is no specific time horizon. It might be that your cash flows become less certain beyond that period, but there is no rule of thumb or no specified time horizon. So that's just one to watch out for, because I have found a number of companies that still have their sort of policy around how many years they might look out. So there are, as I said, there seems to be a continued list that looks about the same for the last year or two on ASIC's radar around issues that they're looking at. I think that the issues there are, so going concern probably links in well with the issues that we've just talked about on deferred tax assets and impairment. So the sorts of issues that we're focused on in the current market, if we've got companies that have poor trading conditions. Now, the other thing that's probably kept accounting professionals pretty busy here in Australia has been dealing with the accounting issues that have come out of the various tax reforms that we've seen in Australia, particularly in the last sort of 12 to 24 months. And so this has been pretty Australian specific. So as I said, we haven't had a lot of changes in accounting literature to deal with, but we've certainly had a lot of financial reporting issues relating to tax matters to deal with. And so the examples here might be, we had a couple of years ago the change to the dividends test under the Corporations Act in Australia, and that then created issues around franking of dividends. We had the introduction of the MRRT and the revised PRRT and dealing with accounting issues associated with that. We've had new R&D incentives and accounting issues there. So I guess what I'd say is that it's more important than ever that in your organisations or with your colleagues that you are well linked into, if you're the tax professional, that you're linked in with the finance team or vice versa, because a lot of the time we're finding these issues are very interlinked and you need to understand both sides of the story. So what we might do now is go global, so to speak, and start talking about the issues that we have got in the pipeline. And so these are predominantly new accounting standards that you'll need to deal with from the 1st of January. And so, these are the various new standards that we have. And on these ones, it'll be applicable first for companies with a December year end of December 2013, and then we'll flow through into 30 June 2014. Now that might sound like a long time away, but as we talk through some of these, you'll see that there might be quite a lot of information that you need to gather and consider, and certain judgments that you need to make. So ensuring that you've thought about that well ahead of time will put you in good stead then to be able to apply the standards. So I'll talk first about the new hedging rules. Now, I guess I've lied a little bit here in that the ISB hasn't yet finally approved these new hedging rules, but we're hoping that that happens very early next year, and so it will be available for early adoption. And this is a good news story. For those of you who have dealt with hedge accounting in your roles, you'll know that it is a very complex process and in many cases can be very difficult to achieve hedge accounting. And what these proposals and new rules will do will greatly simplify hedge accounting. So the general principles of hedge accounting will remain the same, so we'll still have cash flow hedges, fair value hedges, net investment hedges, and the process of hedge accounting will be the same. But what this will really, or the difference here is really about what are the items that you can hedge and what sort of instruments you can use for hedge accounting. So just to highlight a couple of the things that will change, the first thing is that will be some simplification to the effectiveness testing for hedge accounting. So at the moment we need to do some retrospective and prospective hedge account or hedge effectiveness testing, and it's quite complicated. Under the revisions there'll predominantly be prospective testing, and it will be a more simple approach, so that's good news. Companies will also be able to hedge components of risk, and so I guess an example here is we see airlines wanting to hedge fuel purchases, jet fuel purchases, and so they'll undertake they might have a crude oil contract. But under the current literature, because crude oil is only a component of the price of jet fuel, they're unable to get hedge accounting. So under the new proposals, you'll be able to hedge components of risk, so you would be able to achieve hedge accounting. The other aspect is that at the moment we can't hedge net positions, only gross positions, and so the revisions will help here as well because you will be able to hedge net positions. There'll also be some changes in the way you use options for hedging, which will mean that there'll be less volatility in the financial statement as well. So for those of you who do have derivative activity or hedging activity and you've currently thought it's all too hard to do hedge accounting, it might be time when these proposals come out to rethink that strategy as well. There's probably two, or I guess one main thing that you do need to bear in mind is that these proposals are part of a whole range of changes to implement the new accounting standard IFRS 9 on financial instruments. And this is being done in a step-by-step manner. Now, if you apply this if you apply or want to apply hedge accounting early, it means you need to go back and actually also apply the existing new pieces of the literature or the new pieces of the standard that have been introduced. And so ordinarily this standard won't apply until 2015, but if you want to go and early adopt for hedge accounting, you need to go back and early adopt for the other phases of the project that the ISB have already approved. And we'll talk a little bit about some of these other phases after. So the other couple of standards that are new, we've got a new standard on, or a revised standard I should say, on employee benefits, and the main change here is really going to be for those companies that have defined benefits superannuation plans. So in Australia generally find that's relatively few and far between, as most companies have moved to defined contribution plans. So the key change here for those with defined benefit is that the corridor method of accounting for your liability has been removed. And so that might mean that there's some companies that will have some unrecognised actuarial gains and losses that now need to be brought onto the balance sheet. So those of you who don't have defined benefit plans probably are pondering what is the corridor method, but for those of you who know, that will mean something to you. There's also some changes in the way that you're going to calculate the return on plan assets, so that's also something to think about as well. The other piece that is probably more likely to impact people here is there has been a change in the, or some clarification in the definitions of short-term and long-term benefits. And here I'm talking about short-term and long-term benefits for the purposes of measurement rather than classification. And the thing that will be impacted here is our annual leave obligations. And so what these revisions do is say to have something as a short-term benefit, you need to settle the whole obligation within 12 months. And if you think about for most corporates, you don't settle your whole annual leave obligation within 12 months. There's usually a whole raft of people that don't take all their leave every year. Certainly not me. And so what needs to happen in this scenario is you say that's a long-term benefit, which means that you need to discount that entire obligation. So we have had, or that there are a number of companies that won't have considered discounting of annual leave obligations in the past that now need to have a think about that. So I'll move now to the suite of new standards dealing with consolidation and joint arrangements, and these really are, I guess, the big three to deal with from the 1st of January. And I guess if you haven't started thinking about them yet, now is really a good time to do it. And I think what we've found with most of our clients is, you know, there's a large number that would say that these standards actually don't end up having a lot of impact on them. Having said that, most clients have always had two or three examples of subsidiaries or arrangements that they really need to think hard about under the new rules. And that's because the new rules are far less rule-based, there are far fewer bright lines and require a lot more judgment. And you'll probably hear me use the word judgment quite a few times. So the other piece to note here is that the International Board has provided an exemption for certain investment entities from the requirement to consolidate. And so this is pretty new news. So the ISB has said for certain entities that meet a definition of investment entities, they do not need to consolidate, they can carry those investments at fair value through the P&L. Now, good news for international companies, for those here in Australia yet, and I'll get to some of this in a bit more detail, the AASB has decided perhaps that's not exactly what we'd like to do here, so they have deferred the approval of that, and I'll come in a little bit more detail as to what they've decided to do. So rather than take you through, I guess, the nitty-gritty of the standard, I thought I'd just touch on some of the main issues that we've had our clients grappling with. And it really comes to the new definition of control. And so the standard would say that an investor controls an investee when it's exposed to or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Sounds like a fairly long definition. So there's really three key elements to that. The first is the power. The second is that the investor has exposure or rights to variable returns, and then finally they've got the ability to use that power to affect returns. So to break that down even a bit further, the things or the steps that you need to go through, first of all, is identify, well, what are the relevant activities that affect returns? So that might be sales and purchases, it might be asset management, it might be research and development, it might be funding. Then have a think about, well, how are the decisions on those relevant activities made? And so that would be thinking about how are decisions made on budgeting and forecasting, about removal and appointment of key management personnel. And then finally, looking at whether the investor's rights give them the ability to direct those activities. And so in this case, we look at voting rights, we look at potential voting rights, we look at the ability to appoint and remove decision makers. So it really is quite I guess, a detailed process in thinking through. It's not just about what's your ownership interest and you consolidate, it's going through what power do you have, what's your variability to returns, and then looking at what your power is to influence those returns. So perhaps these things are, you know, they all sound quite theoretical until you get to an example. So perhaps I'll just give you a couple of examples. So in this scenario here, we've got an investor A that owns 70% of an investee, and investor B that owns 30%. So let's assume that investor A exercises their votes. They're quite active in the organisation, actively directing activities. At the same time, you've got investor B that also has an option to acquire 50% of investor A's interest. So if they did that, they would end up with 65% of the interest in the investee. So the question here is, well, what do we do with potential voting rights? And this is where there is a difference under this standard compared to our existing standard. So the key thing here is that you need to look at whether the voting or potential voting rights are substantive. And so in this scenario, we'd say, well, given these options are out of the money, then the investor B is unlikely to exercise them. So in this case, you'd say that investor A is likely to have the power or the control.
Now that would be different to our current accounting literature, which would say you need to take into account potential voting rights, and we would say that investor B controls the investee. So that's something just to watch out for, that there is a difference. The other issue that the standard deals with is de facto control. So this is the scenario where an investor might have less than 50% interest in an investee, but still has control. And so the example I might use here, and I might just sort of abbreviate it, but if we've got a company here, so this is a beer brewing company that has a 40% interest in a bottling company that manufactures all their bottles for them, and they take 95% of the input. We've then also got a range of other investors. We've got some that are widely dispersed, and we've got 4 investors here that are all directors of a soda company. Now, looking at this scenario here, one might sit there and think, well, they take 95% of the output. Doesn't that mean that they've actually got quite a bit of exposure to the variable returns on this of Bottleco? But given that the other 4 investors there have 10% each, and it's a fairly tightly held group of investors, it's unlikely that Brewco is going to have the opportunity to control the activities of Bottleco. Now that might be quite different if you had just 40% one investor, and then you had the other 60% very, very widely dispersed, and they never voted together. Then you may well get to the scenario where there is de facto control and you'd need to consolidate, notwithstanding the fact that you had less than 50%. So there are a number of different factors that you consider when you're making this assessment. I won't go through all of those now, but they will be in your packs or available online when you get back to your offices. The last thing as well is that you do also need to think about supplier relationships. And so this is something probably quite new for people to think about, and this is because there could be contractual relationships that also then indicate that you control another entity. And so the example that I've got here is a coffee company that has an exclusive licence with a producing company, and they basically direct the activities of the supplier, and they've got a licence for 10 years to enable them to do that. They get 100% of the output. And so in that scenario, notwithstanding the fact they might only have a 30% interest in that supplier, you could still say that they actually have the power to control the activities, and they get variable returns through their 30% interest. So I guess the message on that one is, and the other one as well, is that you need to look much more broadly than what the direct ownership interest is. So the other significant new standard we've seen is joint arrangements, so IFRS 11. And so this new standard really focuses on the contractual rights and obligations of the parties to a joint venture, and that is what will determine the accounting. And so this is particularly going to have an impact for those companies in the energy, utilities, mining industries, perhaps in the real estate sector or the pharmaceutical industry where we have joint arrangements or alliances. And so under the new literature, we're going to have 2 sorts of joint arrangements. We'll have a joint operation, which is really where the parties have a direct interest in the assets and liabilities of the operation.